Okay, Richard, if you want to go ahead and get started. Our speaker today is Richard Brooks, who is a mentor in the Cleveland area, and he'll be presenting the session.
Thank you, Anita, and welcome everybody to this session on financial management. The previous session kind of built a foundation for you, and we're going to build on that in today's session. For those of you who aren't familiar, here's a image of our website. It's score.org/Cleveland, and if you're interested in getting a SCORE mentor, all you have to do is look at the upper left tab there, right under the word SCORE. It says Find a Mentor. All you have to do is click on that. You can either look for a mentor that you think would fit your requirements best, or you can just simply request a mentor, and we will assign one to you with the skill set that you need. But you do need to let us know in your application exactly what you're looking for, and we will assign somebody with the skill set that you need. Okay, today we're going to talk about financial basics, practicing making financial decisions. And that's going to be the emphasis. I will let you know that this is going to run a little bit longer than 1 hour. So hopefully all of you can stay with us. Okay. Previously we reviewed some of the simple financial statements to see what insights they can provide. We discussed examples of financial data. If we have time, there'll be an open discussion at the end. Okay, if you remember the last time we met, and you were with Chris Santalazar at that time, we talked about Puzzlemania. Now, Puzzlemania is a manufacturer of jigsaw puzzles. And here is a example of their cash flow statement. And you'll notice here that they start at the beginning of the year with a cash balance of $5,000 in January. At the end of January, they end up with over 24,000. And by the end of the year, they're at 36,000 opening balance. You can see that where it says beginning balance, 36,917, and they end up with a balance at the end of the year in cash of 79,760. Now, this can easily be explained because Puzzlemania most likely does the majority of their sales toward the end of the year as holiday presents. But look at the September and October ending balance numbers. Okay, in September, their ending cash balance was only $234, which means if they had any issues in the month of September or the month of October's only $64.57, they were going to have some major financial problems because they did not have enough cash in the bank to actually cover any unforeseen expenses. And this is one good reason why every business should have a small line of credit with a lending institution that they can draw on if they need it. But putting that issue aside, the cash flow statement shows you what your cash position is at any given time. And that's why it's so important, because in every business, there's an expression, cash is king. And you want to maximize your cash position either in ready cash, such as a checking account, or in cash reserves, perhaps a savings account or a short-term certificate of deposit, or other financial instruments that might be available to you, to make sure you always have sufficient cash on hand. And this statement is different than a profit and loss statement because all this is showing you, and we're going to look at a P&L statement in just a moment, all this is showing you is your cash position. It does not show you whether whether your business is profitable or not. Okay, so let's look at a couple of questions on the cash flow. Is the business seasonal? Well, yeah, we've already discussed that. We started in January where we had $24,242 in our checking account, and by the end of September, we only had $234. And the reason for that was probably that July, August, September were slow sales months for them. At the same time, they were building up their inventory for their November and December sales, which was very important. So they had more cash going out, and you can see that here in the cash outline. In July, for example, they had a beginning balance of $58,934. They only took in $11,250 in revenue in the month of July, but they spent $27,837, which was a significant increase, more than or roughly around double what they spent in June. So in July, they were starting to build up their inventory. In August, it was the same story. Okay, and you can see they started out with 42,349. They only took in 10,313, but spent 37,183, and that reduced their cash on hand from 42,349 to only 15,479. And in September, look at what happened. They started out with the 15,479, and they ended up with only $234. That means that they were building their inventory and maybe buying some for the beginning of 20 the following year, but they were producing, getting everything ready to ship to their retailers so that they would have sufficient sales. And you see that the sales really kicked in December. Actually, that really kicked in November with 54,375, and then December, they had their best month of the year with 64,688, easily explained by holiday sales. So, is the business seasonal? Yes, it is seasonal. What are the lean months? Well, the lean months actually start when? They actually start around June and go through September. And so when they plan on this, they have to know how to budget their cash to get them through their lean months. For example, if they overbuy their supplies in August, they won't have any money and may have to borrow money on their cash reserves or their credit line rather to make numbers to be able to pay everything in September and October. So they have to understand that their business is seasonal, and many businesses are seasonal. There are a few that aren't, but most businesses are seasonal. And that's how you're going to walk through this and understand what your cash requirements are. And how might the owner deal with this seasonality? Well, one of the things that they could consider doing is starting to build their inventory sooner. Okay, that's one way to do it, and spread out their purchasing. There is a cost involved in that because obviously they're tying up more money sooner in the year, and there may be some warehousing costs involved in it. But that's one strategy. Each business should have its own strategy in place to determine if it's a seasonal business, how to maximize their cash at any given time of the year. So that's the Puzzlemania cash flow statement and why it is so important to you. Again, it is not the same as a profit and loss statement because it's only showing you your cash position. Here's their income statement. And their income statement is showing whether they have a profit or a loss for the year. The income statement shows all their revenue by product. And if you're just designing your income statement now with your accountant, it is always best to show by product, if at all possible. They produce three different types of puzzles: a 200-piece puzzle, a 1,000-piece puzzle, and a 2,000-piece puzzle. And notice to the right of each one of those sales numbers is a percentage. That percentage is the percentage of sales of each one of these items. And a lot of profit and loss statements, when you get them from your accounting system, whether it be Quicken or Xero or any one of the accounting systems that you use, may not show you the percentage of sales. It is important that either you transfer that over to an Excel spreadsheet and add in the percentage numbers, or see if you can configure your accounting system to actually do that math for you. So in this case, in 2020, total revenue, $360,000 for Puzzle Mania. And then we have their variable expenses. And remember, there are two different kinds of expenses: variable expenses and fixed expenses. And I know Chris went over this last week. Their variable expenses are listed here. And again, the percentages that you see on the right are percentages of sales. Okay, they are not percentages of the actual cost is, they are the percentage of actual cost, not the percentage of sales. We're going to come back to that in a minute. I apologize for the confusion there. And then you see the gross margin. And the gross margin is calculated by the total revenue minus the total variable cost. So the gross margin is what you have available to pay for your fixed expenses. And you have the fixed expenses of $108,000. So for the year, they made $74,760. But I want to go back to these percentages for a moment, because it's important that you understand where this is. They have a 21% gross margin. And you notice here in this slide, we're showing you 3 years of financial history. And what's important here is that the 3 years of financial history show you trends year over year. And it's important. For example, in year one, total revenue, $360,000. In year two, $396,000, which you'll see is a 10% increase. And then year three, $435,600. Okay. And what you want to do is track this to make sure that you are maintaining or improving your sales while maintaining or reducing your cost of sales, which is really important to you. There have been some recent articles about the restaurant industry, the fast food industry, where their sales year over year have actually been flat or negative. And that's become a real problem for the fast food industry, as people have less and less money available to dine out. And as fast food industry, their costs continue to increase. So they are watching this very, very closely. That's on a very large scale. Each one of those franchisees and the franchisor is watching that as well. But in your case, watching these trends year over year is really important. Okay, so to answer a couple questions here, how does this differ from the cash flow statement? This shows you profitability versus the cash flow statement, just showing you your cash position. Did the company make a profit the first year? The answer is yes, $74,760. What product brought in the most revenue in the first year? Well, we can see there that the product that brought in the most revenue is the 1,000-piece puzzle in the first year with $127,500. So they made a a good amount of revenue on that. But more important, what product was the most profitable? Okay. And again, it's the 1,000-piece puzzle. And the way we determine that, okay, is we take the 127,000 and we subtract out the $62,200. So the least profitable is the 2,000-piece puzzle. So that's a really important that you understand what those ratios are, product by product, because this will help you determine if you should continue carrying a product. For example, if you have a product that you're selling or a service that you're selling, and you're generating a lot of revenue, but your cost to do it is 95% of sales, and you only make 5% on a sale, it probably isn't worth holding on to. If there are other products or services you can be offering at greater profitability. So that's part of the analysis of the income statement that you should be able to do. The percentages help you do that, as well as just some simple number calculation. So you want to do that. And it would be very easy to transport these numbers into an Excel worksheet and work out profitability by product. Okay, moving ahead. Here's Lulu. So if you remember, Lulu was is a fictitious beauty salon. Okay, we're looking at her cash flow statement. She starts out the year with 5,000. At the end of the first month, she's at $19,318. And look at the end of the year. She had a good end of year cash position, $116,621 at the beginning of December. And at the end of December, you notice $129,546 in cash. And so the question is, does Lulu really need this amount of cash in her checking account? And the answer would be no. This is where Lulu should go to a financial advisor, go to her bank and say, what can we do to maintain the cash that I need to operate my business, but at the same time, not have it in a very, very low interest, maybe 0.02 or 0.05 checking account, and how can I make my money work harder for me? The cash flow statement gives you an indication of that. The other question here is, are there any significant seasonal variations for Lulu? And in this particular example, we did not provide a seasonal variation. You notice every month her cash position just grows and grows and grows. That may be realistic. It may not be realistic. But that would be something that Lulu ought to take into consideration as well, that she's going to have a solid, a steady or increasing cash flow during the year. One other thought for you. What else could Lulu do for with her increasing cash balance? Well, something she might be able to do is do an incentive program for the operators at her beauty salon that would reduce her cash a little bit, but provide incentives to her operators, number one, to stay with her, and number two, to perform well, because the incentives can be based on the revenue that each one of them produces. So there are different ideas that you can do when you have a very strong and positive cash flow to share with your team members. Not recommending one thing over another, but something to definitely consider. I will tell you, my background is in the hospitality industry. I mentor mostly restaurants and hotels, although I have other clients as well. But I will tell you that when I was working in the hospitality industry, I would always have a way of providing incentives to our team members to maintain the high level of performance that we established in every one of the businesses that I managed. Okay, I want to look at Lulu's profit and loss statement very quickly because it breaks some interesting things down for us that we want to look at. Again, we're doing a 3-year, year-over-year analysis so that we can look at what's going on in sales. Lulu has 3 classifications. She has shampoo, she has hair coloring, and she has other. And the other, you notice, you probably, if this was your business, you'd want to break down other into more detail. And the reason why is it's the second highest revenue generator. And other could be hair cutting, it could be selling cosmetics at the store, it could be massages, it could be spa services. I mean, there could be all kinds of different things that Lulu could be doing, but she's kind of clustered it here as one classification. I would recommend, SCORE would recommend that because it's such a large number, it's their second highest revenue, that she go ahead and break this down in more detail. Following the same examples as we saw with Puzzlemania, there's a breakdown by revenue item of the costs involved, and then her gross margin, her fixed expenses, and her profitability. And you notice the profit continues to grow every year, and she's doing very well. Again, what this shows is a good year-over-year trend. If there's a fall off in any given year, either for the year in total, the month in total, or by revenue classification or sales class or expense classification, you're going to want to do an analysis of that to find out what's going on. For example, if the other costs, the expenses, the variable expenses, go up significantly, you're going to want to know why. Well, have your supplier costs gone up for the same products? Have you added more products on that are higher in cost? If it's a service, did you have to bring in a more expensive person to provide those services? What is the issue here on increased costs going up? If your revenue is going down, what's the issue? Could it be competitive? Do you have a competitor, direct competitor in the area that is charging less for a specific service and you're losing customers to that competitor? You're going to want to know exactly why your revenues are going down. Maybe in Lulu's case, maybe she's got an operator that is losing customers because they're not performing very well. And keep in mind, the most effective advertising is word of mouth. So if the word gets out that, the Mary Jane over here at Lulu's is she's either never available or she left the salon and they've got somebody else in there and I don't want to try her, whatever it happens to be, you're going to want to understand that and be able to take action. So quick question, what services are providing the most revenue? Well, the hair color is the most revenue consistently. And again, the number 2 item is other, and number 3 item is shampoo. What services, what service costs the least to provide? And the lowest cost service is also hair coloring. And we determine that by simply subtracting the 167,700 in 2020 from the 318 and comparing that to the other products being offered and products and services being offered. You should be doing this analysis monthly and on a yearly basis with your own business. What do the percentages tell you? Well, the percentages are going to tell you, um, uh, 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 you know, two things. Number one, are sales increasing or decreasing by product? And number two, are costs increasing or decreasing by product? This will jump out at you if you have a percentages column. And again, recommend either configuring your accounting system to do it, or exporting all of this into an Excel spreadsheet and calculating it yourself. It's very, very easy, and it's really meaningful because you can sit down with your employees or sit down by yourself if you're just a one-person company, and do the analysis and figure out how you're going to improve things. Okay, and finally, how would you increase profitability? Well, there are a couple ways to increase profitability. One would be to add more high profitable items or services to your product line. Okay. For example, maybe adding a tanning bed or two tanning beds to your product line if it's a high profitability item for you. At the same time, maybe looking at reducing costs by maybe changing your shampoo to a lower cost product or your hair color to a lower cost product. There are various ways of doing it, and you need to look at each one of your products or services, especially if there's a downward trend or an upward trend, to understand what you're doing right, what you're doing wrong, maximize what you continue to do right, and reduce your liability on increased expenses. Okay, so far we've talked about normal operations and how that should go for you. Now let's look into what could go differently, better or worse, as examples, and how you might be able to respond. We'd like you to think about how you might use your financial data to adapt to these conditions. That's why we spent the time on the cash flow and the profit and loss statement. Okay, so far we've talked about normal operations. Let's go into some more detailed examples and see what we can learn from this. Okay, so first, how can we use our financial data to help us make a business decision that leads to more profitability? In this case, Lulu, her salon's been open for 6 years and it's doing well. She's considering opening a second location. What does she need to consider to see if this is a good idea or not? Okay, so we did an excerpt here from Lulu's business. On the left is her expenses. Okay, so her salon rent is $4,600 a month. And I'm just going to do something here real quickly. Her telephone cost is $300 a month, and her insurance is $1,200 a month. The salary for one manager is $3,750 a month. Her internet and IT and web service, she's combined that all, is $820 a month, and her utilities are $750 a month. So on average, her total fixed expenses for the month are $11,420. And those are the fixed expenses. Remember, those are the fixed expenses. The chart on the right is her variable expenses. So her shampoo and conditioner is only 2% of sales. Her hair dye and the perm kits are 7% of sales. Her commissions, her operators are on commission. That's 45% of sales. That means she has a 45% labor cost. Her credit card fees are 2%, and she does some advertising in addition to word of mouth. and that's 4% of sales. So her total variable cost is 60%. Now, look at the lower left box. Lulu service 18 clients a day on average, 6 days a week. 18 clients times 6 days a week, and there are 4.3 weeks in the average month. And that's how you use the average month, because once you get beyond 28 days, you get into odd weeks. And so the average month is 4.3 weeks per month. So if we take 18 clients per day times 6 days a week, that's 108 clients a week times 4.3 weeks in the month, with an average service of $120. So if we take the 108 times 4.3 times $120, her revenue is $55,728. Now look at the box on the right. If we take the 55,728 and we take 60% of that, which is $33,437, that's the dollar value of her variable expenses. Add in, or subtract out actually, the 11,420 fixed expenses. Her profit for this month is $10,871. If we take the $10,871 and divide it by the 55,728, she has a 20% profit margin on average, either for the month or the year, however you want to calculate this out. And that's an important number, because if that number goes up, the profit margin goes up, that's a good sign. If the profit margin goes down, you want to know why. Have your sales gone down, but your fixed expenses are the same? So if your sales go down and your fixed expenses are the same, your fixed expenses become a larger portion of your business expenses. And that means your profitability is going to go down. There can be all kinds of issues here, but you need to do this kind of analysis on a regular basis to make sure that you've got a benchmark. In Lulu's case, it's $20. And you can follow that benchmark month over month, every quarter, every year, to see what you need to do to improve the business. Okay, I will tell you, in the restaurant industry, we watch these numbers very, very closely. The number one expense in the restaurant industry is labor, and the number two expense is food cost. They will get close to total 70% of sales. And so in the restaurant industry, if food cost jumps up considerably, or you've had significant turnover in your staff, and your labor cost goes up because the new staff that you bring on isn't as productive as the staff you previously have, that's important numbers to follow. And you need to understand that, and you need to be able to deal with it. Okay, so that's an example of Lulu's. Okay, now Lulu understands this. Let's see what happens. You notice in the example that we just did there, Lulu did not include her income in the analysis. So let's look at it now from that point of view. Okay, so here's another example of expenses. Lulu has $11,420 dollars in fixed expenses. We already saw that. Variable expenses, $33,437, for a grand total of $44,857. Okay, again, her revenue is $55,728. So we look at this and we subtract the $44,857 from the 55,728, and that's the $10,871, which is the 20% profit margin. And you notice here that we actually did a little pie chart to help you visualize exactly what was going on with Lulu's business. Okay, now let's look at what happens when we add in what Lulu pays herself on the average month. So the fixed expenses stay the same at $11,420. The variable expenses go up, or pardon me, stay the same at $33,437. But now we've added in Lulu's income. And what we did is we said Lulu figured that she was worth $35 an hour, and she puts in 55 hours a week, not the 40 hours a week that her operators do, or 35 hours a week that her operators do, whatever that happens to be. But because she's managing the business, she has to take care of the accounting, she has to pay the bills. Her other people aren't doing that. She's responsible for the advertising. So she's paying herself $8,278 a month, which is 15% of sales. So now her expenses, taking into consideration what she is doing, have gone up from $44,857 to $53,135. And you notice what happens there. She goes from a 20% profit margin to a 5% profit margin. And the reason for that is she wasn't considering her own income before. So now we've done the pie chart to show this. One of the things that it's really interesting to see with first-time entrepreneurs, new entrepreneurs, is that when they do their 1, 2, 3-year financial projections for their business, they often don't include income for themselves. And it skews the financial numbers considerably. And when you show this to a lender, one of the first things the lender is going to do is saying, how are you paying yourself? And so your SCORE mentor will always work with you on this. There are different ways of doing it. One way is to just build in a monthly income for yourself. Another way is to if you're profitable, to do a quarterly bonus, which would pay yourself. There are different strategies for this, and your SCORE mentor and your accountants can work with you on the best approach for your business. So it's important here to do this comparison of including your time and what you're paying yourself and what you're not paying yourself. So that's one strategy you need to look at. Let's look at couponing, discounting, because couponing is discounting, to see if that's a good strategy to increase your sales. Okay, here's an example. Lulu is selling hair products at her store. Each bottle of hair product costs her $10, and she's selling it for $20. Okay, so the wholesale price, what it costs her, is 1/2 of the retail price. We call this in the industry the keystone markup. In other words, the difference between what it costs Lulu and what she sells it for, that $10 in wholesale cost versus or subtracted from the $20, that $10 profitability is called the keystone markup. So she has a gross profit per bottle of $10 on her normal sales. And if she sells 100 bottles at $20, that's $2,000 in revenue. Let's look at this in a little bit more detail, okay? $100 times $10, okay, is a gross profit of $1,000 gross profit. So on $2,000 worth of sales, she has $1,000 of gross profit. Well, we would expect that if her markup is literally the same as her cost. Makes sense, right? Her cost is $10. She's selling it for $20. That gives her $10 of profit, and she has $1,000 in gross profit for selling for that period. If we take the $1,000 divided by the $2,000, that means she has a 50% gross profit margin. Now, that's under normal conditions. Let's see what happens when she decides that she's going to try to increase sales by offering 20% off in store and online of your entire purchase of her entire hair product line. Okay, so let's look at this. Your cost per bottle stays the same at $10 per bottle. Your new sales, however, changes considerably. Now, instead of making $20 per bottle, you are only offering at $16 per bottle. So you have to take the $20 and subtract out $4, which gives you the $16 because the $4 is the reduction. That's the 20% of $20. That's $4. So her gross profit margin per bottle of hair product goes from $10 down to $6. Well, how did we get that? We took the $20 cost or $20 revenue that we would normally make, that Lulu would normally make. We subtract out the $10 that it costs Lulu, and then the $4 discount that we're offering. So now we've gone down to $6 gross profit per jar. Okay, so if we sell 100 bottles at $16, that's only $1,600. Remember, it was $2,000 before. If we multiply the 100 bottles by $6, that will give us $600 in gross margin profit. Okay, that $600 is 37.5% of sales versus 50% of sales if Lulu had kept the number at $20 versus $16. So the question is, does it make sense to offer the discount? Well, let's look at this. Lulu's selling 100 bottles at $20, $2,000 in revenue, $1,000 in profit. Selling 100 bottles at $16 gives you $1,600 in sales and only $600 in profit. So let's figure this out in a little bit more detail, okay? $1,000 in profit divided by the $6 per bottle in profit means that she would have to get $1,000, 167 bottles of the hair product in order to get the same $1,000 in revenue. We would need to sell 167 bottles with a 20% off coupon to make the same profitability as 100 bottles with no coupons. So then the question is, can Lulu sell the 167 bottles? And let's talk about a couple scenarios there. Okay. Question number one, if her market is flexible, the term is actually elastic. If the market is elastic and by reducing the price, she can create more demand, Lulu can determine whether she can sell 67% more product to get the same profitability. Okay, maybe she does the sale just before Easter or just before Thanksgiving or just before Christmas or whenever, and that's an opportunity for her, for people to come in and buy more product that they would use throughout the year. So there is a strategy involved in this. Another reason that Lulu might want to do it is maybe the product is not selling well, and it's costing her money to hold on to that product. Remember, this goes back to that analysis that we talked about earlier in the profit and loss statement about determining whether a product or a service you should be holding on to that or not, and maybe replacing it with something else. So maybe Lulu's decided to discontinue that product entirely or bring in a different product that would sell better or potentially sell better. And so it's really important that you do this kind of analysis to make this kind of determination. So this is one way to look at it. Now, moving along, let's talk about, is advertising worth it? We're going to look at it a little bit differently than what we did with Lulu's analysis. Okay. In Puzzlemania, their average revenue is $30,000 per month with a 21% profit margin. And we're going to be talking about the return on investment in this analysis. They get an idea to do an ad for Puzzlemania, and the ad will cost $2,200, and it's going to bring in $14,000 in new sales. So that looks pretty good. So to calculate the gain on the promotion that they're considering is if they take the 14,000, which is what they're going to generate in new sales, and they take 21% of that, which is their profit margin, it should generate $2,940 of profit before the ad expense. Okay. If we take that $2,940 and subtract out the $2,500, whoops, there we go. The $2,200, somehow that slide slipped there. It actually creates for the ad itself $740 a profit after the ad expense. Okay. Remember, we didn't include the ad expense before in that 21% profit margin. That's just their normal profit margin. So if we look here at the bottom, 14,000 in sales divided by $20 per puzzle. That means that in order to generate the $14,000, they have to sell 700 puzzles. Okay. And if we take the $740, which is the net profit after they subtract out the $2,200, it's a 5% additional profit margin. So what is their return on investment? Well, the formula here is you take the gains, which is the improvement in profitability, and the $2,940 minus the $2,200, which is their investment cost, and divide that by the $2,200. So if we do the math and we take the $2,940 and subtract out the $2,200 in cost and then divide it by the $2,200, the return on investment is 34%. In other words, the $740 is 34%. Okay, so that's a decent return on investment. Let's look at the same example, but in this case, it's $2,500 for the same ad. It generates $14,000 in revenue, $2,940 in profitability. But in this case, when we subtract out the $2,500 from the $2,940, it's only $440 versus the $740 if it's the $2,200. And that makes sense. It's $300 more expensive. Okay. That only gives us a 3% profit margin. Using our return on investment analysis, it only generates an 18% return on investment. So the question is the 18% really worthwhile or not? And it's this kind of analysis that you ought to walk through when you determine whether an advertising campaign or another way of promoting your business is going to actually generate revenue. And this is also another way of looking at Lulu's. We decided to look at it two different ways, but Lulu might want to do the same analysis on discounting. What is her return on investment? Okay, moving ahead, let's talk about some real simple strategies that you might want to consider. First one, fire your worst customer. Do you have customers who expect the same discounts that your largest customers get, but don't buy as much from you as those largest customers? You have customers who pay their bills in 60 to 90 days instead of your usual terms, which is payment on receipt. In effect, you're their credit card, and you need to do something about that. You have customers who dispute many charges. They say, no, this charge is wrong. You told me that was the price, whatever it happens to be. You have customers who return large portions of the products that they buy from you because they're unable to sell them. These are all examples of reasons why you need to look at these customers and make a determination, are they really worthwhile? Now, you don't want to have a business where you only have 2 or 3 customers, because if one of those customers decides that they're not going to continue with you, that's a significant hit to your business, and you really don't want to do that. At the same time, if you have a bunch of small customers and 2 or 3 large customers, and some of those small customers are saying, hey, we can't be competitive with your product because the guy down the street is getting more of a discount from you than we are, that's not right. And so you have to kind of deal with this. I can tell you, in the hospitality industry, in the lodging industry, there are 2 or 3 tiers of discounts. And what we do in that industry is, if somebody comes in the door and says, I've got this company, it's down the street, and I can give you, your hotel 10 occupied rooms per quarter. What kind of a discount can you give me? We would give them the first level of discount. Maybe it's a 10% discount on guest rooms, because it's worth it to us to capture that business. If another company comes in the door and says, we're going to give you 100 rooms occupied per quarter, what kind of a discount can you give us? Maybe we'll give them a 15 or a 20% discount to capture that additional business. But we monitor that business. And if they don't meet that quota, that 100 guest rooms in the quarter, we will go back to them and say, you didn't make it. And because of that, we're going to give you another quarter to make up the difference. If you don't make it in the next quarter, we're going to move you to a higher discount. In other words, instead of the 15 or 20%, we're going to move you back to the 10%, because you're not making the numbers that you told us you were going to make. And we took the gamble along with you by offering you the additional discount. And we need you to kind of make up for that. So that's a strategy that you might consider as well. The 60 or 90 days, by all means, if they're using you as a credit card, say to them, look, I can't afford to keep you on as a customer because you're not paying your bills on a timely basis. I have to call you. I have to remind you. I have to send you emails. I've sent, once or twice I've had to go to a collection agency on you, and that's cost me money. You just have to be straightforward with them and say, I'm going to put you on payable upon receipt, and if I'm not paid within 10 days, I'm just not going to refill any orders for you. So these are strategies that you might want to consider. Okay. You need to look at your customer base and figure out which customers are your best customers, hold on to them, and deal with the customers that you don't want. Okay, next one. To expand your products and services. Number one, build a defendable fort first. Okay. And I get this directly from my experience. For many years, I worked for Nestle. Nestle actually had a hotel and a restaurant division at one time. They don't anymore, but I worked for them. And Nestle's approach to everything that they did was they built a defendable fort, either by producing great products that competitors could not match or building a reputation for a product. The best example of that is their lean cuisine product. When they brought it out in the mid 1970s, they positioned it as a diet conscious, healthy product for people who were looking at not necessarily losing weight, but not gaining weight and still enjoying good food. They brought it out slowly. They brought it out in test markets and then regional markets, and then they brought it out nationally. And to this day, lean cuisine holds about 50% of that market segment's sales. Now, the way Nestle did that was they built a defendable for two ways. Number one, a high quality product. And number two, they had a high value to that product. Okay. So as you develop your value statement for your business, that value statement ties directly to building a defendable fort. Okay. And when you have that defendable fort, it's difficult for your competitors to pierce that defendable fort. Test your ideas with your customers. Before you go into a new product or a new service, talk to your repeat customers. Find out from them if they would seriously consider purchasing the product or service that you're talking about or that you're considering adding. Minimize your investment until you know that you have a market. That's exactly what Nestle did with lean cuisine. They've done it with other products that they've brought out, and they've been very careful about how they bring it out and introduce it to the market, letting people know that it's there, showing the value. In some cases, you may decide, okay, to get this product or this service going, I'm going to go to my repeat customers and I'm going to say, I'm going to introduce this product. And for you, my repeat customers, I'm going to do 10% off just to get knowledge of that product and start building a customer base. You let them know it's a temporary discount and just to get going with it. Do a competitive survey. Find out what your competitors are doing, which is really important. Is there a hole in their product offering or service offering that you could be filling? So find out what they're doing, including what their pricing is. You can probably figure out what their costs are based on their pricing, because you may be using the same suppliers, that kind of thing. And then finally, think outside the box, but be cautious. If you're doing, for example, Lulu's salon, maybe adding on a line of women's t-shirts or other kinds of things that normally people would not find in a salon, but you could add value to bring it in your salon by providing value t-shirts, value blouses, might be a way of doing it. So just think of ways of bringing in additional business that may be non-traditional for your market. Okay, and finally, what does thinking outside the box mean to you? It's going to be different for everybody, okay? And then the other one is, how would you build a defendable fort? Again, your value proposition is going to be key to this already. And do you have a defendable fort already and just are not promoting it? So think that through. Finally, reduce your fixed costs. Go back to your landlord, see if you can renegotiate your lease, Be sure you're taking care of all your tax credits you're entitled to, especially if you're a home business. Work with your accountant on this. Some businesses aren't including mileage as a cost. If you have to travel at all for the business, you're not including your cell phone. There are other things that may be expensive to you, and they're legitimate business deductions that you can take from your business. And in effect, because they're legitimate deductions, reduce some of your tax liability, which improves your profitability. Consider lower cost suppliers, but sometimes they may actually be more costly. So be very careful if you're considering a lower cost supplier like Puzzlemania, their fiberboard. Maybe that fiberboard does not hold up as well in the production phase as the previous one, and therefore their costs actually go up. So be careful about that. And then finally, consider bundling. You see this all the time. Bundle your home and auto, and add on your SUV, and add on your boat, and all this other kind of stuff. Look at that versus having one carrier for your business insurance and another carrier for your business vehicle insurance. Put that all together, see what you can do about that. And then your question to consider is, what are your fixed costs? Which ones are negotiable? Which ones aren't? In many cases, you can renegotiate your rent by extending out your lease. If your location is working out very well, but your lease costs are higher than you anticipated, maybe going back to the landlord and saying, I have a 3-year lease. Can you work with me? If we're on a 5-year lease, let's reduce my monthly cost on this, okay? Or you may be in a situation where there are a lot of vacant stores in the area, and you can say to the landlord, look, I can get a better deal down the street. I need you to reduce my lease cost. The landlord is going to know that there's plenty of vacancies in the area. And if they want to hold on to you, they want to continue at least some level of revenue in the store, they may be willing to work with you. Okay. And then how would you verify comparable value when researching lower cost suppliers? You test the products first. And then the effect of borrowing. Don't want to spend a lot of time on this because we're running out of time. We're already over the 1 hour. What if Lulu encountered a large unexpected expense like flood damage and had to borrow from her line of credit? And how might interest affect your cash flow? Let's look at this real fast. Puzzlemania has relied on their in-house accountant for many years to keep their books and prepare their taxes and assemble the useful data to help them make decisions. This is their in-house accountant. She organized their files using only a system that she understood. One day, she resigns and moved out of town slightly. What can they do? Okay. This is a real issue. Did she abscond with the money? Okay. Nobody's going to understand it. How do you rebuild the books to make sure that they're okay? And by the way, the number one answer is every industry has a uniform chart of accounts for their business. Make sure that your accountant is using that uniform chart of accounts. If you do that by bringing in another accountant, okay, they can pick up exactly where the previous accountant has left off. The other advantage to that, by the way, is that you can then compare your operating revenues and expenses against industry standards. Let's look at this next one. Lulu used an automated software product to manage her shop's finances. The software company abruptly goes out of business, leaving no source of customer support. How can she regain some accounting capability? Number one, again, make sure that you're using the uniform chart of accounts for your industry. And number two, she can require from the software vendor that the data be transportable to other systems. And you can require that, and it's very easy to do. You just export the data into an Excel file and make sure that it is exportable. And then most of these accounting systems now can take Excel or similar kinds of products and import it into their systems so that you are able to maintain the historical value, the historical numbers, versus having to rekey everything for years and years and years. Okay. And what would you do in similar situations? Very easy to answer. Make sure that you have protected yourself going forward to make sure that these kinds of scenarios don't happen to you. And then what about your business? Are you accounting for your own time? How might coupons and other discounts work for your business environment? What factors would you consider in deciding whether or not to advertise? What would you do to fire your customers? How would you approach expansion of your business? Ad tips, any tips for reducing costs that you might consider? How would you adjust to a costly setback? You have a flood in your store, and all of a sudden you need extra cash to replace inventory, to replace damage in the building, whatever it happens to be. How would you adapt um, uh, um, if you need to increase inventory? I have a client right now whose inventory needs to be constantly increased because her sales are increasing, but she's pumping all of her improved profitability back into the increased inventory. So it can become a nasty cycle for her, and we're working through that right now. So it's something to consider. And how might you overcome obstacles to data collection and analysis? So you need to plan for all of this in what you're doing on a daily basis. We're finished with the presentation. Again, your score metric can help you with all of this. Anita, do we have time for a couple questions?
Yes, I'll do the ones in Q&A first.
Okay.
One question, is there a target or a good number for gross margin that we should aim to hit?
It depends on the industry. It's a very good question. It depends on the industry. Okay. I will tell you in the restaurant industry, 7 to 10% is a good net profit margin before taxes. A gross profit margin, I know some industries that 80% gross profit margin is a normal industry standard. Uh, I know some businesses that 60% are gross profit margin. And that, remember, gross profit margin is your revenue minus your variable expenses. 60% is good. And a lot of industries, 25, 30, 35% gross profit margin is good. So it really depends on the business that you're in. There is a way of verifying this, and that is there is an industry neutral database out there that you can go to verify industry average gross profit margin and expense margins. Um, and You can get that at the Cleveland Public Library. The business librarians know what it is, and your score mentor knows what that website is. The reason why I'm suggesting you use the Cleveland Public Library is that there's $1,000 subscription fee if you do it yourself. But if you use the Cleveland Public Library, they can give it to you for free. Next question.
I would just mention that you might even be able to use AI to search for that information.
Yeah, that
Um,
may also be available. Yeah,
How do you factor in for annual increases in wages, such as performance-based reviews linked to increased wages?
that's a very good question. You have two forms of wages. You have variable cost that is directly related to the production of the product or the service that you're providing. So, for example, I'll use a restaurant as an example. Let's say that I'm paying my average server $8 right now, and that $8 goes into and is considered a variable cost in my restaurant. However, my manager is on salary, and let's say I'm paying him $3,000 a month, and for my server, they're doing really well, and so I'm to maintain keep them on my staff. I'm going to raise them from $8 to $8.50. I run that directly as an increase against my variable cost. If I'm paying my manager a 10% increase, and I go from $3,000 a month to $3,300 a month, that is a fixed cost. And the reason for the difference there is the server, I may not schedule every day of the week. The server may only be working 30 hours a week, whereas my manager has to be there 40 hours a week. And my server, their scheduling is based on my projected demand, whereas my manager has to be there all the time. So that's why the server is directly attributed, their cost is directly attributed to the cost of actually selling a meal versus the manager who is responsible for general operation of the restaurant. And therefore, I cannot take his $3,000 or $3,300 salary and attribute it to the sale of one meal. So I hope that makes sense to you, and I hope that you can apply that to your business.
And you actually, if you're in the service business where you're giving annual increases, that needs to be built into your budget.
Yes,
And you might have to increase the price of your services or your products to accommodate it.
right. Right. And that's not at all uncommon. Most people understand, prices are going up. Food costs to restaurants, I will tell you, is on a wholesale basis, is averaging more than 10% a year at this point.
Okay. Can we clarify how the percentages for each variable expenses was calculated?
Sure. What you do is, I'm going to see if I can just scooch back here real fast. So thank you for waiting. Okay, let's use Lulu's. Okay, so Lulu has a total of $668,800 in revenue in year 2020. So the shampoo, the color, and the other classifications are all percentages of that revenue. So in this case, if we take $668,800 and divide that into $120,000, that's 18% of her total sales. If we take the 668,800 and divide that into the 318,800, that's 48% of sales. And then the $230,000 is 34% of sales. We do the same thing with the total variable expenses. Her total variable expenses for 2020 are $401,250. If we take that $401,250 and divide that into $99,750, we see it's 25% of the total variable expenses. We do the same for the color and the other. Okay, so that gives you that type of percentage. Okay, you can also look at it differently if you want. You can take that shampoo cost and divide it. You can take it as a percentage of the shampoo revenue. So in that case, you could take the $99,750 and divide it into the 100, or divide it by $120,000, okay, and that'll give you your variable cost of sales for that product, okay, for that individual product versus as a total for the total variable cost. So there are two different ways of looking at it. Okay. Another
Okay.
question, Anita.
What would be a reasonable interest rate for a loan for business?
Um, uh, Interest rates are really complex, and the reason why I'm saying that is it depends on whether you're doing a new business or a an existing business. Existing businesses, and the reason for that is there's a track history. The lender knows that the business is viable and is more likely to be sustainable in the long run. Um, the general average, um, new businesses have a 50% failure rate within 2 to 3 years. Existing businesses, if they make it through those 2 to 3 year periods, um, have a much greater chance of long-term viability, and therefore lenders are willing to take a greater risk. With that in mind, the current interest rates that you'll find for new businesses are anywhere between 9 and 11%, depending on the business. For example, restaurants tend to be higher because interest rate because they have a higher failure rate, whereas some other businesses, maybe that are considered more essential to the economy, might have a lower interest rate. Existing businesses might be 1 to 2% less than that at the current rates.
So what are the best accounting services to use for by a small business?
I would look, well, first of all, I want to make sure that we're talking about two different things here. Number one is your in-house accounting system. And, the most popular of all those is Quicken. There's FreshBooks, which is a simpler version of QuickBooks. It doesn't provide all the detail that QuickBooks does, but it's a much lower cost system, FreshBooks. There's Zero, which is comparable to QuickBooks, but it's only for the Apple product line. QuickBooks does have an Apple product because QuickBooks has gone from an accounting system you put on your computer to a subscription service that's cloud-based. So there are 4 or 5 that are really good. My suggestion is go to consumer and not consumer reports, but there are you can get information that will compare all the different accounting systems out there, and you can make a determination what fits best for your business. For example, with QuickBooks, they offer certain accounting templates based on the chart of accounts for specific industries. And so instead of having to set one up, you can just tell QuickBooks, I'm doing a restaurant, or I'm doing a retail store, or I'm providing home health care, whatever, and see if they actually have a chart of account already set up for you based on the industry standard. If you're looking for a third-party accountant to actually do the work for you, I would avoid very large firms. So, companies like Ernst & Young and some of these other very large companies, PwC and some of the other ones, are terrific companies, and they will do a great job for you. The problem is, number one, they're very expensive. And number two, you get the junior accountants who are just really getting into it at this point. My suggestion is to look for smaller accounting firms that specialize in small businesses. Rule of thumb that I give my clients: if it has more than 3 names in it, you don't want them. So our SCORE chapter has a list that your SCORE volunteer can provide you of several different accounting firms, small business accounting firms. They can provide you with that contact information. You then have to make your own phone call because we cannot recommend a specific firm by our charter. And you can make the phone calls, you can interview these accounting firms and determine which ones are best for you.
I believe there actually is an article on our website that talks about how to choose an accountant or an
Yeah,
attorney.
that's right. So if you go to our website, in the tips and tricks section, you'll find a lot more information than what I just gave you.
And there's someone who says the Landbrit Group is a business that helps small businesses. Again, there are lots of firms that help small
Yes.
businesses.
Yeah.
And again, you don't want to just pick one. You want to
Right.
review a number to make sure that you're getting one that really suits your
Right.
business.
Right. Remember, all of our mentoring is free. Okay. I've worked with clients that have paid people to put together a business plan and have provided, advising services to them to get their business going. And this is not to speak badly of any of those services, so don't get me wrong. But they've ended up coming to SCORE because the business hasn't worked out as they had anticipated. They can no longer afford those firms, and we've been able to provide them with help on a free basis.
How do you get a different mentor if the one you get assigned is not skilled in what you need?
Um, uh, and I've had this happen to me a couple times where people have said, I'm not getting what I need. What do I do now? You can be upfront with your score mentor on this. And if that's the case, by all means, tell the score mentor, um, uh, and we will go out and find the right mentor for you. And I'll give you a great example of something. I have a client, or I had a client from Detroit, and that client was originally assigned to a mentor in Detroit that did not have the knowledge base that the client needed. That score mentor went out and looked at our national database to find a mentor that fit this client's needs. And they contacted me, and I took the client over. Um, we're pretty thick-skinned about this, folks. So if we don't have the skill base that you need, um, tell us, and we will find the right person for you. Keep in mind one other thing. Um, the first mentoring session that you have should help you determine, you and the mentor, whether that mentor is right for you. Either they have the knowledge base that you need, or maybe there's no chemistry between you and the mentor. Maybe you're not comfortable telling them everything that you need to tell them in order for them to help you because it's just not the right chemistry. Be upfront on this. We're pretty thick-skinned about this, as I've said, and we will help you. And I've actually had one or two clients where I've said, I'm not the right guy for you, but I'm going to find the right guy for you, and connect you, and you can go forward from there. So our objective is to help you, and if we're unable to do it, we'll find the right person for you.
Okay, I think that does it.
Very good. Thank,
Again, we will be sending you the slides and the link to the recording. And if you have further questions, you can certainly email Richard or me. Richard would be the preferred one. Um, I will put his email address in the chat. All
And I
right.
want to thank everybody for staying on this as long as you did.
Yeah,
We try to
yeah.
get this done in just an hour, but this topic is just too lengthy, and I apologize for that. You notice, I think I took 3 breaths the entire time to get through this.
Okay, so everybody back to work. Have a good day, and we'll see you the next time.
Thank you all.